Hello traders, this video is recorded by George Beaulieu, the founder of 24elliottwave.com. The title of this video is how to trade breakouts using Elliott Wave part 1. In this video we're going to discuss how one can recognize a valid breakout. Alright, we know that a lot of traders like to trade the breakouts. Alright, so sometimes you will see these traders will try to waste your time and even mess up your trade. But there is a better way one can trade a valid breakout. I would like to refer traders to the video that we call Breakout Trading, recorded by George Beaulieu, myself. You search on Google, Breakout Trading by George Trio. So if you go to YouTube, you type in Breakout Trading by George Trio, you'll see a video, which is called Breakout Trading. I refer traders to that video so they may understand, breakout trading. In this video, we want to apply the Elliott Wave, to detect a valid breakout. All right. So when we are talking about Elliott Wave, we work with Elliott Wave principle. One of the principles that I will use in this video to detect a valid breakout is the extension, wave extensions. All right. We know that the first wave, the first wave, the third wave, and the fifth wave can be extended. All right. So the first wave, the third Elliott wave, and the fifth Elliott wave can be extended. All right. If the first Elliott wave and the third Elliott wave are not extended, there is a high chance that the fifth wave will be extended. All right. So now you see what we are talking about. We want to work with Elliott Wave principle to detect, a valid breakout. So the strategy that we're going to use in this video is that when we see the first Elliott wave that is not extended, all right, we also notice that the third Elliott wave is not extended. We know that there is more than 70% of the chance that the fifth Elliott wave will be extended. So when we count 1, 2, 3, 4 waves, and we have noticed that the first wave is not extended, the third Elliott wave also is not extended, there is a high chance that the fifth wave will be extended. So we'll be looking for a breakout during the fifth Elliott wave. The Elliott Wave principle allows traders to stop a fight in the market. Why traders lose? Traders do lose because they are fighting the market. So you think that the price is going to go up, all right? So you buy, but the price is going down. You have misread the price. You have understood the price, all right? You have failed, to interpret the price. So you buy, and the price went down. On the other hand, you think that the price is going to go down, you sell, or you sell aggressively, and the price goes up. To avoid losing trade, one must keep eyes on the price and work with market principle. The wave theory allowed the Elliott Wave practitioner to avoid a fight in the market, but to flow with the market. All right. So it's very simple. I'm going to show you here on this chart. The reason why I'm speaking slowly like this is to get your attention. So this video is not for public show. It's for educational purposes only. All right, to show traders, how, to trade breakouts using the Elliott Wave. Now I'm going to record 3 videos. This is the first video. So stay tuned. All right. So the first video is about the fifth wave extension. All right, so I'm going to draw lines on my chart. So, and we're going to apply the Elliott Wave. And my intention is to simplify the wave principle without diluting it. All right. So we see the first wave, and then we see the third wave, a reasonable normal third wave without any extension. And then we see the fourth wave, all right? And now, this level here, the end of the third wave, there is a resistance there. That's the last high. So there is a resistance here. All right? So, as the price approaching this level, this resistance level, during the fifth wave, all right, a lot of aggressive traders will place orders here to buy. You'll see, in fact, there are a lot of orders will be placed here. Littered, the whole place will be littered with orders to buy. Now, one principle also I need to mention to traders here is that where there are orders, the price will go and fill these orders. Now, you didn't get what I said now. I just said something very important. Where we have a lot of orders, the price has a high chance to go to these orders and fill them up. All right? So you want to know where are the orders. So the price will come to the high of the third Elliott wave because neither the first wave nor the third wave is extended. We know that. So the price may find a resistance first and pull back a little bit. People will think that the correction has started. And then we will see a breakout here. As the price breaks above the high of the third Elliott wave, we will buy right there and place our stop loss below this low here. Alright? Why do we need to buy? We need to buy because we know that the first wave and the third wave are not extended according to the wave principle, without a fight in the market, without forcing the market, without assuming anything, without getting too excited like a little child. We will wait for a clear-cut signal above this resistance level because there is a high chance, not a certainty, it's not guaranteed. Okay, get it right. It's not guaranteed that we will have an extension. I will come back to that, all right? It's not guaranteed, but we know that there's a high chance that the price has a high chance to go up more. All right? You get it now? If you are a more experienced trader and you think that, George, come on, say it quickly. I'm speaking like this, okay, because of new traders, all right? So, by applying, by just knowing one principle and observing the first wave and the third wave, we can predict that the fifth wave is likely to be extended. What is a fifth wave extension? The fifth wave extension means that the fifth wave will be going up for too long. Normally, this is another Elliott wave principle. There is very often, this is not guaranteed, this is not exact science, there is equality between the first wave and the fifth wave, as it was at the beginning, so it shall be at the end. So very often you see that the length or the magnitude of the first wave will be equal to the magnitude of the first wave. So we will project the first wave here, and we will assume, ladies and gentlemen, we will expect, all right, we will expect the fifth wave to go up the same length like the first wave. But because neither the first wave nor the third wave has been extended, there's a high chance that we may see a bit of push to the upside. Ladies and gentlemen, as I'm speaking to you, explaining to you this Elliott wave principle that we can use to detect a valid breakout, either breakdown or breakout, breakout for bullish trade, breakdown for bearish trade, using the Elliott wave principle. We don't want to force it, ladies and gentlemen. We don't want to assume anything. We don't want to get too excited. One thing I have noticed, because I've met a lot of traders, I've communicated with a lot of traders, and what I have noticed that the mistake that a lot of Elliott wave traders are making, even some of the very experienced Elliott wave traders are making, is that they are trying to force the market. They are trying to go ahead of the price. They are trying to, to be too smart. They are showing total disrespect to other market participants, and they don't want to check the fundamentals. All right? So the first tips and trick about breakout trading using Elliott wave, we can use the wave, okay, principle, a wave rule, a wave guidelines. In this video, we are talking about the wave extension. We know that only 3 waves during the multi-wave can be extended. The first wave, the third wave, and the 5th wave. If the first wave is not extended, all right, and the second wave is not extended, there is a high chance, not certainty, do not forget that, not guarantee, there is a high chance that the 5th wave will be extended. As the 5th wave is underway, the first challenge, the first breakout is the high of the 3rd wave, because this is the 4th wave. If you like, a color is now in different color, all right? So you may see it clearly here, all right? Orange, that's the 4th wave. So first wave, second wave, 3rd wave, and 4th wave. Now, at this point in time, because we have analyzed the internal wave of the first wave, we have also analyzed the internal wave of the 3rd wave, we have noticed that these 2 waves were not extended. Now, the first thing that's coming to our mind is that there's a high chance, that's all, there's a high chance that the 5th wave will be extended. So as the 5th wave is underway, after the 4th wave, you see that it starts first here, the 5th wave, push it fast, 2, 3, breakout, now it break above it. Now, because we know that it's a high chance there will be extension, if you receive a buy signal above this resistance here, we can manage the trade, place our stop loss here, depending on our risk tolerance, sometimes we place below this resistance here, depending on what you want to do, all right, or use a put, call option, all right, and we will see, we will look for opportunity to buy, expecting the 5th wave to be extended, which means the price will push it down, and the 5th wave will be formed of a 5 minor wave. An extended 5th wave is a complex wave that is formed of 5 minor waves. It's a very beautiful, okay, Elliott wave, the 5th wave extension. Before you get too excited about this video, all right, if you like it, by the way, like it, all right, we want, okay, interaction between traders. If you like it, like it. If you don't like it, okay, don't keep quiet, dislike it, all right. If you like it, like it. Don't just go away after watching this video. Do you like it? Yes. You don't like it? Mark it down. All right? That's what we want to know. We want to see interaction. You have any question? Put it below. All right? You want to have any comment? But trade data, okay? Spamming, okay, the YouTube. We will remove their comment. Very simple. All right? Now, the next thing I need to mention to trader, because my trading approach or my wave trading approach is about combining, okay, the technical with the fundamentals. So at this point in time, as the price is breaking above here, what do we need to do? We go to Google Finance, we go to Yahoo Finance, we go to Bloomberg, we check the economy news relating to the financial instrument that we are trading, we check the current market environment. Is the market bearish? Is any major economy new, political new, okay, natural disaster affecting the market? What's going on? What is the market cycle? This is about the trading triangle. The market first, the sector, before the individual financial instrument, the heart of the trading triangle, the market, the S&P 500, the sector, okay, the markets, okay, the heart of the trading triangle, we have the market leaders, okay, the market leaders in each sector will affect the market itself, which is the S&P 500. The economy news can also change the market, all right? And the fundamentals. Very often, sometimes, a lot of Elliott wave traders will get into trouble because they see that the first wave is not extended, the 3rd wave is not extended, and they will expect the 5th wave to be extended, but the 5th wave will not be extended because the fundamentals are weak or the market is bearish, all right? And you won't see any extension. And you will be saying to me, George, this mumbo jumbo about the 5th wave extension did not work, and it will never work. And it's not true. No. Suppose at this point in time, as we have seen for Cisco stock that came recently, giving a bearish warning to the investor. Suppose at this point we are trading Cisco, and it came out with this bearish warning to the market. Do you think that the price will be extended bullishly? The market is formed of human beings that are analyzing fundamental data, the market sentiment, all right, the market environment before they make their decision. They want to buy at the best price, at a fair price, okay, in order to make profits. So if at this point in time we see that the market is bearish, or we are in the bearish cycle, but this stock is due for an extension, we will not see any extension. The opposite also is true in a downtrend. If you like, I can draw the picture for you for the downtrend. For the downtrend, we see the first wave like this. Are you following me on my chart as I'm drawing on this chart? And then we see the second wave. And then we see the third wave, which is not extended. All right. And then we see, okay, the fourth wave. Are you with me? All right. And then we will expect at this point in time, because neither the first wave nor the third wave are extended, we will expect the fifth wave to be extended. If the fundamental becomes solid at this point in time, the price will not go down. Suppose at this point in time you were here and you were trading, for instance, Apple stock, and Apple company came with some good news, with some strong fundamental that has exceeded the analyst forecast. The market will not sell it. They will instead buy. So instead of expecting an extension, a bearish extension of the fifth wave, you will not see it, because it's not all about a technical alone. It's about the fundamental and the technical together, using the trading triangle. In this video, we are talking about how to trade breakouts using the Elliott wave, part 1. We are concentrating on the wave extension, especially the fifth Elliott wave extension. Only 3 waves can be extended: the first, the third, and the fifth wave during the motive wave. The motive wave is formed of the first wave, second wave, third wave, fourth wave, and the fifth wave. This is what we call the motive wave. An Elliott wave cycle is formed of the motive wave and the corrective phase. All right? So, are you with me? All right? Another thing I need to mention to traders, sometimes traders get into trouble because they are counting the wave and they get into trouble. If you are counting the wave, 1, 2, 3, 4, the price should be where? Should be in a rising channel. So you are counting the bullish waves, and you count 1, 2, 3, 4. If the price is not in a rising channel, there's a high channel, you are doing something else. On the other hand, if you are counting 1, 2, 3, 4, during a bearish waves, or you are counting 1, 2, 3, 4 bearish waves, and the price is not in a declining channel, you are doing something else. All right? You are doing something else. As always, when one is counting wave, one must not count the wave and stop on one single time frame. It's a mistake. So, for instance, here we are on an hourly chart of the Australian dollar and New Zealand dollar. All right? If you count the wave on this hourly chart and you just stop on this hourly chart to make your decision, you are likely to make a mistake. Why? Because the market is fractal. That's why sometimes they get into trouble. They count wave on the 5-minute chart. We see recently I posted a video on our YouTube channel about how to trade Elliott wave on the 1-minute chart, where they go around and marking a video down because they do not understand anything about Elliott wave. When we are counting wave on the 1-minute chart, we do not stop on the 1-minute chart alone, because the market is fractal. All right? If you are counting the wave on the 30-minute chart, on the 4-hour chart, on the hourly chart, do not count the wave and stop on that time frame alone. You must check at that time frame to validate your wave count, because one can make a mistake. So to avoid making a mistake, we will compare our wave count to the wave patterns on a higher time frame, so that everything aligns nicely for us. But as I explained to you already, it's not all about technical trading alone. It's about the fundamentals, the economy news, the market leaders, all right, the market environment, and these are the things that we want to work with together, so that we do not make mistakes. To avoid losing consistently, one must not disregard other market participants. Sometimes, when one is during the wave count, we see what we have very often what we call a distortion. This is what is creating a bit of difficulties in the market when to the accounting way, because sometimes there are distortions that are due to economy news. Major economy news can distort the market or the wave patterns. The first question a trader must ask always: where do breakouts take place? So if you don't know where the breakouts take place, you are likely to get into trouble, by the way. All right? Breakouts takes place at a valid resistance and support level. Full stop. This is the key of this video. A lot of traders are breakout traders. We see all the time market open, and the price goes a little bit above any resistance, even on the 1 minute or the 2 minute or the 3 minute. People call it breakout. Breakout of what? And sometimes the price will go above the key level only to come back down. People say, oh, no, this breakout is not working. This strategy, George, I don't want to use this strategy anymore. Breakout takes place at a valid resistance and support level, supported by strong fundamentals. Why? A bullish breakout means that the price is now, the financial instrument is now accepted, for a higher value. So there was a resistance here, which was the high of the third Elliott wave, and the market rejected the price at that point in time. That's why we have the fourth Elliott wave. For one reason or another, the market decided to bring the price above it, which means a new valuation is taking place. A company that is valued at $20 billion is now $25 billion because the market thinks that there's more value in this company. Or sometimes it's just due to the fact that the sector, in fact, is bullish. Everybody wants to buy gold, everybody wants to buy silver, everybody wants to buy commodity. The commodity market was bullish when the Federal Reserve was printing, the dollar. All right, so that's why we talk about the markets. All right, the market, the sector, and individual financial instrument. If the market is bearish, we will apply bearish strategies. We will put aside our bullish strategy. So whenever the market is bearish and we are looking for a bullish breakout, we will not use that strategy that day. We will not trade those stocks until the market itself is bullish. If the market is bearish, we'll pull out our bearish watch list and we will focus on those stocks alone. Because why? We don't want to fight the market. All right? It makes sense? It's also powerful. So, as the price breaks above the high of the third Elliott wave, the first target is the length, equality. This is another Elliott wave principle. Equality between the first wave and the fifth wave. So we will project the fifth wave right here, by the first wave right here. See, the first wave was here. Usually there is an equality of a magnitude on length of the first wave and the fifth wave. So as the fifth wave is underway, we will place it here like this. So we will say that, first target this level here. Because the first wave and the third wave are not extended, we are expecting the market to push it a little bit up. All right? But the market does not have to. It does not always have to. But there's a high chance they will do that. But what are we doing? We will not just go and buy anyhow or sell anyhow in a downtrend, all right? We will just know that something is likely to take place. Now we check our fundamental and we are waiting. Like a cat. Right? And when we receive a signal, we will take it. If the signal fell, if the music has changed, the dance must change. You just pull out like a soldiers, all right? You just pull out, all right? Like a captain will pull his soldiers, pull out, pull your money away, and wait again and see what's going on. But the trouble that we face with the Elliott wave traders is that sometimes you have done your wave count, you have done your analysis, everything aligned for you carefully. You are very sure that, this is what is likely to take place, and you don't want to be flexible. Say they are wrong. No, the market is never wrong. Well, it's never wrong. The price can be distorted but you don't want to fight it, all right? So you see it, okay? They start selling here like mad because of the dangerous trader that see orders here to buy. So as these orders are filled, another group of traders that like to make other traders to lose, which I like to call dangerous traders, see this order being filled, they will sell them down, take them out of their trade first before pushing them out. So we don't want to discount the activity of the dangerous traders, as I like to call them, all right? We don't want to discount that. Or, for instance, the prior hit went above the resistance, but at that point in time, there was some bad news coming out from this company. The stock will not go up. So as we see for Cisco, in fact, I'll bring Cisco for you, which I bought recently. The price went down for a while, but then they quickly ran back up because of the warning that Cisco, this is it, you see here? It just ran down. Boom, 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 down. Look, from this level of the price went to the 21, we bought it, it ran fast, all right? So you see here, I entered this trade live on YouTube. There was a video live swing trading at George Rio channel, okay? We entered the trade here, price ran fast. And look, here, Cisco came out with the warning, and boom, the price got down, all right? So for swing trading, you will use a bigger stop loss. If you are day trading, you are taking profit consistently. Now, after that, the price went horizontal, but some people want to sell it more. Price push it down, okay? And then now, again, it's start going up again. All right? So you see how the market is changing consistently, the economy new, the market sentiment, the market environment, all right? This is the message I want to communicate to traders so they start adopting the mindset of professional traders. If you are a new trader and you are learning Elliott wave, do not get too excited about it, all right? If you are day trading, take profit consistently. If you are swing trading, I'm going to record a video later on that I will call a split swing trade, which I will show you how to swing trade, okay, without risking too much money, all right? But the key point trader must understand here, we want to avoid the fight in the market. We want to trade the price. We want to flow with the market. We don't want to fight the market with the Elliott wave because the Elliott wave is the purest technical analysis. But my approach is to combine the purest technical analysis with the fundamentals without discounting other market participants so that we don't get into trouble. All right? It makes sense? So, a breakout will take place at a value resistance and support level. Nothing else. So we look for them on a higher time frame like weekly chart, monthly chart, quarterly chart, at least a higher time frame, higher than the daily chart, okay? Breakout will take place at most of the breakout traders trade on a daily chart. I know that. They look for breakout on a daily chart. Right? But because they see the resistance on the daily chart, sometimes they probably break above a resistance level on the daily chart, but on the weekly chart, there may be a resistance just above that resistance on the daily chart. So price goes above the resistance on the daily chart for a while, and then hit the next resistance level on the weekly chart, and it's now sold down. Or the price deep below a support level on the daily chart, people say breakdown, but there is a better resistance right below that support level on the daily chart, on the weekly chart, and the market will buy it and the price go back above it. All right? So if you have been trading using Elliott wave for a long time for breakout purposes, the fifth wave extension allowed the Elliott wave practitioner to make excellent decisions because according to the Elliott wave principle, the first, the third, and the fifth wave should be extended. If the first wave, the third wave are not extended, there's a high chance that we will see a lot of breakout during, the fifth wave. A fifth wave extension is a fifth wave that is formed of a 5 minor wave or 5 internal wave. To learn more about wave extension, go to www.24elliottwaves.com and click on wave extension. Hope you have learned something from this video about breakout trading using Elliott wave and will put it into use to make excellent trading decision. Until the next time, enjoy yourself and be very happy. We are the TSTW traders. Speak to you soon.